Now, markets have sent mixed signals about the strength of the economy. Stunning rallies in AI stocks have powered markets to record highs. Meanwhile, safe havens like gold and silver also near record highs. Analysts say both rallies have room to run. Still, investors, they have a reason to be wary, right? We've been here before. As we saw Friday, U.S.-China trade tensions can still rattle the markets. And the collapse of First Brands and Tricolor are raising concerns about private lending. If we listen to Jamie Dimon, he warned, look, when you see one cockroach, there are probably more. Ken Fisher is the founder and executive chairman of Fisher Investments. We cannot think of a better time to have you on. So I'm hoping you're ready. You're going to roll up your sleeves because we have a lot of questions. Firstly, can you just review the landscape we just went through there? We have the stronger earnings. We have a resilient U.S. economy, AI boom. And yet then there are the issues with trade, anemic employment. But the thing that's really bothering a lot of people here are the valuations. What do you see here? Do you see more risk? Do you see more opportunity? Are you worried about a market correction?
Well, first, Paula, thanks for having me on. Second, because you're from Canada, in your honor, I wore my global stock market tie with my fig leaf on it. And when you think global, it's important to remember that this year, most of the major markets in the world have been hitting all-time highs and been hitting them fairly recently, if not as fast as we have. Markets outside of the United States are up more than America is. And the fact is, it's a global bull market. The reality of that is pretty indisputable.
Indisputable, but do you just hang on here? I mean, some people are saying, look, I want to take some money, I want to move it. What do you do? Because others say, do not try and time this market.
So let me punctuate that even more so, Paula. Most people overwhelmingly are terrible timers. I'm not a very good timer. The fact is, if you think you're a really good timer, you probably aren't. There's precious few of them. And to be able to time anything that's volatile in the short term requires a set of skills that not very many people actually have. And for the most part, the people that think they're really good at it aren't. If those people existed in large volume, you'd know of their names. They'd become so famous so fast that they'd be legends. And you can't find them. You can find a few in history, but only a few.
So I hear you. Stick it out for now, ride this market. I think that's what you're saying. I do want to ask you about AI, though, and the valuations themselves. Record capital investment. You've been bullish on AI for years. I have to say that. Go ahead. Go ahead.
So let me say this really succinctly. You know, there's three things you say: the one you meant to say, the one you say, and the one you knew afterwards you should have said. Valuations have never been predictive of markets in any way, in any time period that real investors really care about. 1, 3, or 5 year periods or shorter. There is a long history of valuations. There is a long history of market movements. You can test them any which way you want, including the famous Cape-Shiller PE, which was used originally by Robert Shiller and still is over a 10-year basis, not shorter time periods. And the numbers that Shiller used for 10 fall apart when you use his data over 1, 3, and 5. Valuations are not predictive.
And that says to you, you stay in that AI bull market. You continue, if you're invested, you stay invested.
Well, mind you, a time will come when it's time to get out of that. That's for sure, but it won't be predicated by valuations. The fact is, when you think about what you move toward, it comes down to an assessment about expectations versus subsequent realities. AI has a great future. AI is very different than the internet bubble of a quarter century ago.
So
AI has its own problems, but it's about expectations versus reality, and there will be a good reality. The question is, are expectations too high?
Uh-huh. And then that brings us to another topic, the U.S.-China trade war. I mean, it really jolted markets in the last 5 or 6 days, and it really blindsided many. Are you worried about it?
So I worry about China in the long term, but I see China differently than most people do. China is in a stage of its economic and market long-term descent, and that has been true for a long time now. It's been true largely since Xi came to power. That's why Xi is more focused on non-economic growth and more on things like militarism and geopolitics. The fact is, China's very patient as a country, but they're very strategic, and I do worry about them. But in terms of the trade function, I'm going to go back to what I've said from the beginning of all things about Trump and tariffs. Tariffs tend to be significantly worse for the country that imposes them than the countries they're imposed upon. That's one of the reasons that America is lagging the rest of the world in the stock market this year. It's also true that tariffs don't really work the way people think they work. The issues of what unveiled with the rare earths is, and I just want you to think about this because people don't, the total amount of imports into America of rare earths is about 170 million US a year. The total amount of imports into the US from China is about 200 times bigger. The fact of the matter is, America or many other countries, I mean,
right.
Japan's the biggest importer of rare earths, but it's not that impossible to build rare earth capability, and it's just a matter of having the will to do it.
Okay, understood. And we'll wait to see if that will happens among the United States and its allies. We're going to go through rapid fire if you're game here for a minute, Ken. So you just have to answer if you think it's risky for the market or not risky for the market right now. We're going to bring in a nice stoplight over here. I'm going to flash red, yellow, or green, depending on what you say. Okay, we're starting on rapid fire. Inflation, a risk to the market, caution, or not a risk for the market?
Not a risk at all.
Ha! So we get a green one on that one. We don't have time to elaborate too much, but we will take it under advisement. So not a risk at all. Okay, it's going to stay probably at 3% or under. Next, jobs, anemic job market. Does that worry you?
Moderately, not much.
All right, I am giving that one a caution yellow. Did everyone hear that? Caution yellow on the job market. Keep your eye on it. We have a shutdown. No jobs numbers for a while, but we have other indicators we can look to. Interest rates, so much of a debate right now. Do you believe the Fed will help this market and help the economy? More cuts at a quicker pace?
No.
So you're giving me a stop on that one. You're saying this Fed will not be helping out this market as much as some people wanted to.
As much as some people isn't all people. I think the Fed probably does what its current expectations are, but no more.
Gotcha. Okay, and the last one, and I know a lot of people have been thinking about this. Gold, it's at a record high. No one can even really plausibly figure out why. Stay in that gold trade, and do you predict it'll go higher? A risk to the market or good for the market?
So I don't think gold particularly has a broader market impact at all. I gave up trying to forecast gold when I was young because I was terrible at it. And I took a solemn vow that I would never predict what would happen to gold in the name of good luck. And I've been lucky since, so I'm going to stick with that.
You're going to stick with that. Ken Fisher, you've been a good sport, and we have learned a lot. You made it through rapid fire as well. We didn't have the last light on because, as you said, gold, not an issue. Ken Fisher, we will have you back anytime, and let's wait to see what this market holds for us in this final quarter. Appreciate it.
Thanks for having me, Paula.